Good morning and welcome this morning to Managing an Options Portfolio, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab, and I'm joined out there in the chat by my good friend Michael Fairborn, also a 20-plus year veteran of the financial markets. We're going to be talking a little bit about managing an overall option portfolio, and you guys get a peek into my cluttered option mind here this morning as we go through a couple of positions that perhaps have been neglected, which, it's safe to say that that's probably the normal state for a lot of options traders is that we put trades on and then we forget about those trades at some point. Then we remember that we've got to do something with them. So we're going to talk about that as we get into this discussion today. Mike's there to help facilitate the chat. Ask him questions along the way. He is well versed in this topic and able to help answer those questions. If you're watching this in the recorded version, welcome to you as well. We'd love to have you leave a comment in the comments section, and we will address that comment as well. Let's jump on into a couple of quick housekeeping items, though, as we get started this morning. Remember that everything we talk about is simply for illustrative and educational purposes only. It is not a recommendation of any particular strategy or security or account type or anything else. Remember that options carry a high level of risk. They're not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options before you're considering any option strategy. It doesn't matter whether it's a spread trade or a single leg option. And make sure that you understand the strategy that you're looking at. Remember that multiple leg option strategies can involve multiple transaction costs, so be aware of that fact. Also remember that if we're trading American style options, anytime that a trader is short an American style option, there is the potential for that option to be assigned early, which means that it could be exercised prior to expiration. That means that you could be in a short position and it could be in the money, it could be out of the money, it could be at the money, it could be long dated from expiration, it could be close to expiration, and there is the possibility that it could be assigned. And now there are times when that possibility is higher than others. We'll discuss that in this discussion as well. Remember that the Paper Money platform, we're talking about the Thinkorswim desktop software platform here, the Paper Money version of that platform, great learning environment, not a guarantee of future success out there in the real world. However, it does not facilitate the early assignment of short options. So be aware of that as you move your practice from paper trading to live trading. Now, we're going to use some technical analysis in this discussion today. Not a guarantee. It is theoretical in nature, as is probability analysis as well. That doesn't reflect any degree of certainty of any event happening. Remember that past performance, no guarantee of future results. We'd love to, though, have you ask questions along the way about any of those topics and any of those ideas. Let's take a look at what's going on out here in the platform this morning, and welcome to all of you. In 25 years, Mike. Oh, wow. Okay, 25 years. By the way, remember, you can follow me, you can follow Mike, you can follow all of the other coaches on X, at Ben Watson CS, at Mike Fairborn CS. The naming convention is similar for the other coaches as well. You can also follow me on LinkedIn, and I think Mike is close behind me on LinkedIn as well. Cameron's over there, Barb's over there, Rachel Deschelle is over there as well on LinkedIn. If you want to use that particular social platform as opposed to, say, for instance, X or Twitter or whatever it's currently called, let's take a look at what's going on in this portfolio. I've got a bunch. If any of you know me and watch any of the other webcasts that I teach, you know that I always have a number of positions in my groups that I can draw from as a possibility, whether I'm looking at multiple leg option strategies, whether I'm looking at zero DTE strategies. By the way, if you're going to trade a zero DTE strategy, managing that strategy becomes of ultimate importance because you might also have time constraints, liquidity constraints, gamma restraints. Those are influences on those shorter dated strategies for sure. But I've got a number of groups here. Now, I will tell you this. We've got a workshop coming up in Denver this weekend, Friday and Saturday. I'm going to get on an airplane tomorrow morning, fly over to Denver, and I'm going to be there with Ray Kimbrell, Scott Durfee, Kevin Horner is going to be there, Rachel Deschelle is going to be there. So it should be a great workshop. We're going to be talking about technical analysis and option strategies, and managing those strategies is one of those things that we will be discussing. So I've started to put together a group here, and this is kind of rotating from the workshops that we teach. By the way, if you want to join us, come and join us This event is at no cost to you. We'd love to have you there. I'll show you some resources to find that here in just a minute. But I've got a bunch of options positions in this kind of rotating group that I have that I use as example trades in those workshops. So I just wanted to use this as an understanding of how we might go about managing positions that perhaps have been neglected. Because, like I said, to be fair, I tend to neglect some of these positions because I use them as examples. So let's talk about this as we get into this discussion. So I've got a couple of positions in here, and here's a great example of a position that I've kind of let sit here, if you will. The first one in this group, this is Johnson and Johnson. And the first one in this group is a single long call. And I probably used this as an example in teaching a workshop some time ago. As a matter of fact, if I look at the date here, I can tell you that that was an example that I put on in our Atlanta. Actually, I put that on in an Atlanta workshop, and then prior to that in an Orlando branch event. And it's been sitting there for a little bit. It's now sitting at 23 days to go until expiration. So it's down into that time frame where a couple of things are going on. One, Delta's kind of staying the same. Two, the impact of implied volatility is diminishing. But three, and probably the more important scenario, is that the influence of time decay is very likely starting to really work on this trade. Now, it is an out-of-the-money option at this point. Johnson & Johnson currently trading at 240.76. This is a 260 strike price. So this is an out-of-the-money option. So its delta is not very high. So any directional movement that we get out of the underlying stock is not translating into a lot of price movement in the option premium. So any time decay that we get, which is working against us in this particular case, is perhaps overwhelming that influence of delta. Now, that can change as the price of the stock were to move. For instance, if the price of the stock were to move, you're very likely to see delta overwhelm theta. But that may be a scenario where we don't really have the opportunity for this to get back to where we could break even on the trade, where we could really even make a significant amount of profit on this trade. At the moment, which we paid for this trade, we paid $2.78 per share times 100 shares for this option contract. It's currently trading at 85 cents. Wait, hold on. Back that up. See, this is that maintenance nature of this discussion. This was a short call against that long stock position. I have a long stock position in this particular Johnson & Johnson position. So this is have you ever done that? Let's just be honest for just a second. Have you ever looked at a position and said, hey, this is not doing what I wanted it to do, and then realized it's doing exactly what you wanted it to do because it's doing what you had intended it to do to begin with. You just misread that plus or minus. So that just happened to me. Happens to you. I'm willing to bet that it's probably happened to Mike Fairborn on one or two occasions. But this is doing what we want it to do. And you know when I realized it is when I looked over here at my profit and loss on this position, and it's actually doing what I expected it to do. So let's talk about this for just a second, because 6 of one and a half dozen the other when it comes to managing, because we're getting down to that point where it maybe behooves us to manage this position either long or short. So I'm going to go to the trade tab, and we're going to take a look at this April 17 expiration short call position in Johnson & Johnson. Thanks for letting me explore that little adventure there, J&J, and we'll pop over here to our option chain, and here is our 17 April expiration. Guys, it happens. I mean, that is just the reality of the situation, especially as you build larger option portfolios, is that you tend to perhaps, plus minus whatever, right? what's a little bit of delta between friends, right? So here's our 260 call that we are currently short, the 260 call. And I'm going to just change this layout. You can see now, again, same scenario, right? If we were long this option, that's definitely working against us in this particular case. What's interesting to me in looking at this particular option, Greeks at this point, are that the delta and the vega are similar in this particular case. We've got a 12-cent delta, so it's directionally sensitive to the tune of about 12 cents per dollar move in the underlying stock. And the vega sensitivity is just about the same, 12 cents per percent move in implied volatility. So before we go any further on managing this, I want to kind of come back to our chart here, and we'll put this on our single grid. I'm just going to bring up my single grid chart, and we'll put Johnson & Johnson in here, J&J, and take a look at this particular chart. And I've got implied volatility here. So there's a couple of things going on. We're getting some directional upward movement, which is working against us really in this particular case, since we're short this call option. The 260 strike up here, you can see that that's well out of the money in this particular case. And now starting to see that directional movement up off of that level. So I'm long the stock because this is a covered call trade. So that's working for me on the stock basis, but it's working against me on this short call position. So the question is now, do we just take this trade off or do we let it sit here? Because realistically, is there much chance or much probability that we're going to get to that 260 strike? And that question we can answer from a statistical standpoint here in just a second. But we've also got implied volatility that is relatively high and falling. My guess is, so we had a late January earnings announcement. My guess is that we're just over the horizon here in April, probably past our expiration. We've got an earnings announcement coming up. That's why implied volatility is relatively elevated. Let's do this. Let's go back to the trade tab here. And I want to kind of close these up really quickly. And I want to just get a sense. So we're going to look at our list of expirations here. Here's the one that we're focusing on, which is the 17 April. It's got a 28% implied volatility. My guess is that our earnings announcement coming up is in this next cycle. So we're seeing some elevation in the 17 April. It's probably that next earnings announcement is probably in that 24 April expiration cycle, because that's the one that has the most elevated level of implied volatility. The option market, even if we didn't look at the date, that option market is going to give us a picture of where that next level of earnings announcement might be, because of that implied volatility. That's generally going to drive that higher implied volatility. So we can do that a couple of different ways. We can look at the chart. I'm just going to extend over the horizon a little bit time-wise. We'll just take this out to about 50. Actually, we'll take this out to 30 bars. Out to the right, click on apply and OK, and bingo. There it is. It's actually on the 14th, so it is in that expiration cycle. So in this particular case, I probably did. You're right, Lakshmi. I think I probably had 100 shares of the stock somewhere, because we probably created this as a collar trade as opposed to just a pure covered call. We'll look at that here in just a sec. But the scenario is this. Are we likely to get to that 260 mark? No. Are we likely to continue to see this maybe staying below that level? Probably so. You've got a pretty good resistance in this particular case right up around that 250 mark. So the likelihood is we could theoretically, as a trader, leave this option in place as it moves, as the price of the stock even moves a little bit higher, and simply look at taking this trade off by collecting the rest of that 85 cents. The problem is there is always that possibility that the price of the stock could move. Now, does it move higher? Does it move significantly higher? Suggest that maybe this would end up at the money or in the money at that 260 strike, or are we far enough away from the short strike to just let this expire worthless? And I'm often in a position where I'm not going to let a stock expire worthless, or excuse me, an option expire worthless. When I'm short that option, I want to take that trade off prior to expiration, because I'm really carrying that risk here through expiration, or through the time that I take the trade off, regardless of how much premium is remaining in the trade. I'm taking the whole risk of that position. And the whole risk of this position is having the stock called away from me in this particular case. So yeah, I created a collar trade here. I've got 100 shares of stock elsewhere in this portfolio. So this was a covered call. This was the collar trade that we created in one of our workshops as well. So similar type of scenario. But so what do? Do we take this trade off and close it down, and then maybe roll it out and bring in a little bit more premium because we're kind of in that inflated implied volatility space? The price of the stock is moving up, which means that those calls are becoming a little bit more expensive. Or do we let this sit and kind of cook for a little bit longer and bring that premium down just a little bit so that we can buy that back still prior to expiration, but at a lower premium? So there's a couple of different ways that we could trade this from that perspective of managing a position like this. And yeah, I'm glad that I'm glad that you're hearing my kind of stream of consciousness thought process. This is on purpose, but to be fair, this is kind of the mental conversation, along with a lot of song lyrics and movie quotes and things like that happen in my head when I see things like this. But this is the kind of the internal conversation that goes on with making a decision about these processes. There's never one best scenario. What is the better scenario, perhaps, in this particular case for managing this position? So first of all, let's kind of segment this. Let's talk about the likelihood that this call goes in the money, and provides that greater risk of that stock being called away. Because remember, the risk exists. Even though we're out of the money, we're short this option, there is the potential that somebody could, in order to collect, say, for instance, a dividend, could convert this long call into ownership of the stock. Now, you're right, Ted, there's not a huge risk of being called out here. And as a matter of fact, if we look at the chart, we see that we're already past the last quarterly dividend X date here. So we're not going to have another dividend date until after that earnings announcement and after this option expires. So that diminishes the possibility. Doesn't eliminate it. There still is that possibility, right? That it could be called away. Especially if the price of the stock were to make a big move to the upside and this were to get close to that at the money position. So one of the ways that we could assess the likelihood of this option being at or in the money is to simply look at delta. So let's go back to our trade tab. And let's open up this expiration and let's look at this particular strike price. And we can say, look, this strike price has a delta of 12 cents, which means that is objectively a 12%, kind of an approximation basis, a 12% probability of being at or in the money at expiration, or in the money by 1 penny, for instance, is really how kind of that approximation looks at things. So that's about a 12% probability that it's going to be in the money, which means that it's about an 88% probability that it's going to be out of the money. Great, cool, okay. Now here's the thing. I'm going to change this column from extrinsic. I'm going to change this actually to probability of touching. Now here's the thing. Probability of touching is a little bit different than probability in the money or probability out of the money. Probability of touching suggests, based on implied volatility, the likelihood that the stock gets to that point, not necessarily stays at that point, but touches it within that time frame. So there is a higher probability, in fact, about a 21%, almost 22% probability that the price of this stock touches at some point, based on implied volatility and also based on historical volatility, the possibility that the price of the stock gets to that 260 level. Still very low. So not enough necessarily to perhaps induce me to say, I'm going to take this off right now, simply because of that probability that it could be touched. And the fact that just being touched, just the fact that the price of the stock could go from 240 to 260, 20-point move, just because it touches 260 doesn't mean that immediately we're going to be called away. This is at any time, this probability of touching. And here's the difference. Probability of touching also takes into account the fact that that could happen at any time between now and expiration. Probability of being in the money, probability of being out of the money, if we change that column calculation, that assumes at expiration, not at any time during that time frame. So this probability of touching function gives us that assessment of where this could be at some point between now and 23 days from now in making that decision. So the fact that we're kind of sitting here at this point where implied volatility is falling, that's working for us. Price of the stock's moving higher, that's working potentially against us, suggests that, I mean, at 21 days, we're going to start to see this time decay accelerate, but we're going to start to also see Vega reduce. So we know that time is going to pass, that's the inevitable. We know that as we get closer to expiration, Vega sensitivity is going to go down, but what Vega does, what volatility does, is not an inevitable. So let's kind of get one more real quick sense of where that implied volatility sensitivity, that Vega sensitivity, might go to. So what I'm going to do is I'm going to keep this. We know that we're at the 260 strike. I'm going to now come to a shorter dated expiration. I'm going to come out to, say, for instance, 2 April, which is 8 days to go until expiration. Yeah, Ted, and you're right. That's why typically dividends are the driver of early assignment, because the option buyer who's willing to sacrifice their extrinsic value is recapturing that extrinsic by claiming the dividend. So the point at which that likelihood increases is the point at which the dividend payout is greater than the amount of extrinsic value remaining in the option contract. So I'm going to go to the 2 April expiration here, and we're going to look at the 260 strike. So we're just going to look at this strike. And so you can see what's happened here at this 260 strike. Our delta has gone down quite a bit, simply because as we get closer, so remember, it's gone from 12 to 2. What's happening is, because of gamma, that curve is steepening. So the range of delta is kind of getting squeezed in. That overall delta bell curve is squeezing in. Tails are getting longer but flatter. The curve is getting more peaked. So delta sensitivity has gone down a little bit. The delta at the at-the-money strike is probably just about the same as our 27 days to go until expiration. But our probability of touching, I mean, obviously that's gone way down, because the probability of the stock getting to 260 in 8 days is significantly lower because there's just not as much time. But let's take a look right here. Now look at what our theta has done. This is also a function, because remember, our theta, if we go out to our 23 days to go until expiration, our theta at that point was 6 cents. So we've actually got a higher theta. We're out of the money. Now we go to our 8 days to go until expiration, and we go to the same strike, and look at what's happened to theta. Theta has really dropped by about 4 cents, but so has Vega. Vega's dropped by about 10 cents. So here's the problem. We kind of hold on to this trade, right? We hold on to the trade, and we're getting less delta sensitivity, so less directional sensitivity. We're getting less theta sensitivity because this is an out of the money option. And we're getting a lot less Vega sensitivity. So if implied volatility is going down, that's working in our favor, but to a much, much diminished degree than it was 20 days out. And theta is working in our favor. The passage of time is working in our favor, but because we're far out of the money, to a much more diminished rate, because that theta curve is peaking too. So we're getting directional sensitivity, which isn't working against us as hard. What do? Do we take the trade-off? This is the conundrum that we run into. I don't know if you've ever seen this. You can raise your hand if you like and identify yourself. You don't have to. But have you ever seen an option, especially a short option like this, that is far out of the money, that just takes forever as you get close to expiration for any remaining extrinsic value to decay away? I've seen it. I'm seeing it right here. This is the kind of the same scenario, right? So it becomes a challenge. We think, cool, I'll just let this decay away. But it takes forever to kind of pick up those last nickels of this trade. It doesn't necessarily benefit us to do that. It perhaps would be more efficient for us to roll to another strike. So I don't know that we're there yet. I think we're kind of in that intermediate zone. And so what I might look also at is this 10 April, 16 days to go until expiration. Let's look at that 260 strike. And the 260 strike still has about 6 cents of delta. It has about 4 cents of theta, which, that's still working for us. Vega has diminished, however, right? That Vega has really kind of dropped off as an influence as much as it was. It's cut by about half from where it was, or where it is currently in the position that we're short. So the drop in volatility is not going to help us very much. Theta is still helping us a little bit, but we're not getting as much delta sensitivity. So this might really be kind of the sweet spot here, is around that 16 days to go until expiration. Now, here's what I'm going to look at. So just because, I'm kind of getting to that point where I want to do something to manage this trade, we could look at rolling this. But maybe we're not quite ready to roll yet, because if we roll, we're going to get more premium. We're going to be able to collect more premium, but we're still paying a little bit to get to close down the one that we're currently short. So we might be looking at this in terms of where that sweet spot exists. Maybe as we get closer to, or that sub 20 days to go until expiration time frame, where the curves are starting to steepen. Delta curve, theta curve are both starting to steepen. Vega curve is starting to flatten out because we're losing that Vega sensitivity a little bit, where this now maybe becomes a little bit more effective for us to close or roll as we get into that, 10 to 15 days to go until expiration time frame. So what I'm going to look at doing perhaps is creating a conditional order here. And so I'm going to say this, let's build this conditional order. So I'm going to come back to my position. We'll go back over here to the monitor tab. And I'm going to right click and I'm going to create a closing order. I'm just going to do a closing order here. So we're not dealing with necessarily the subjectivity of rolling, but we could roll this. I'm just going to look at closing this trade out. And I'm going to do this. I'm going to say, fine, let's, I would do that, I want to look at the calendar really quick. So I'm going to say, look, let's get to the 10th of April, which is going to be about 16 days to go until expiration. That's going to be our trigger point. So we're going to go here. We're going to right click. We're going to create a closing order to buy this back. And I'm going to buy it back for just about, I'm going to try to buy it back for just about, and I don't know for sure what this is going to be trading at, but I'm going to kind of look right here at this midpoint between the bid and the ask on the 10 April expiration and kind of use that as a target guide here and say, look, if I can get out of this for about 25 cents, kind of somewhere in the midpoint of those two, then that's where I'm going to look at exiting this position. So we're going to create this order. We've got it already kind of queued up here down on the bottom. I'm going to pop this up real quick. And I'm going to say, look, I want to get out of this trade. Let me kind of move these over. And I want to get out of this trade, which means I'm going to buy it back for about 25 cents or less. So 0.25. And I'm going to put that on as a limit. And what I'm going to do is I'm going to make this a good till canceled order. But what we're going to do is we're going to put a conditional on this. So I'm going to click on the little gear icon here for our conditionals. And I'm going to say, look, let's make this a conditional. And I'm only going to submit this order to exit to get us out at 25 cents or less when we get down to that time frame. Now, we could probably just get away with, in this particular case, saying, look, let's just close it out now if we can get out for 25 cents or less. Because then if we get a big volatility dump, we get a big stock price dump, this could go to 25 cents pretty quickly. But I want to illustrate this process. So I want to say, look, I want to get out of this trade, and I only want to submit this order after April 10th. So on April 10th, I want to submit that order, but only after that point, because now we're down within that kind of 15 to 10-day window prior to expiration where we may get out of the trade. And so, here's the thought process, right? We're kind of we're kind of using the conditional to put ourselves in that sweet spot for managing this particular position. Could we do it just as a limit order at 25 cents or at 20 cents? Yeah, absolutely. But I want to kind of keep us in this time frame because I want to kind of keep this going a little bit. If we do get a dump and it does go to that point, then we can come back and revisit it if implied volatility dumps. But I'm going to go ahead and save that conditional. And I'm going to go ahead and click on confirm and send. And I'm going to read through this order because I just want to make sure that this order it's going to do what I expect it to do, which is be submitted on April 10th and then close that trade down, right? So that's the scenario here. And I'm going to go ahead and I'm going to click on send, and we're going to fire that order off, and that's going to sit there. So that's one way to go about doing this. So Barbara asked the question, do I ever look at the chart and use technical analysis to help me make my decision to roll versus close? Sure. Because look, here's the thing. You go back to this chart, and why would I roll versus close? Well, I might roll simply because the price of the stock is still doing what I expected it to do. And that's really the driver of cover call trade, is owning the underlying stock. And if that underlying stock is still, and I'm still of that bullish opinion that then would suggest owning the underlying stock, then I may continue to roll and continue to collect. Now, if this were to start to move parabolically like it was right back here in this January timeframe, that may not be the appropriate time to put on, or maybe the most beneficial time to put on covered call trades, because there's the possibility that could get blown through. And if the intent is to hold the underlying stock, then putting on a covered call at that point maybe doesn't make sense. So if I were exiting out of a covered call and in the stock were going parabolic, I may just close the trade as opposed to roll. So that's the possibility or the process of using technical analysis to make those decisions, right? So Ted asks a great question. So wouldn't the option holder be able to get both intrinsic value and the dividend by buying the stock and selling the call? Sure, they could, but they don't always do that necessarily, right? Buying the stock and selling the call. Buying the stock, they're buying the stock at market, right? So whatever that stock is currently trading at, and then they've got to sell the call option. So I mean, there's some efficiencies here. Now, it doesn't always happen, and that's why you say you don't always get called out on a covered call trade unless it's deeper in the money, and then there is that much greater likelihood, in fact, almost the inevitability of that happening, right? Okay. So that being the case, that's one of the scenarios here. So let's talk about this. I've got a couple of other positions here. I know that we've looked at. I know that there were a couple that I've done in Rachel's class. I know you talked about, mentioned that the Akamai trade. So let's look at that. Let's kind of come back over here to our monitor tab. There's our Johnson & Johnson trade. Let's kind of scroll down here and let's see if I've got that Akamai trade in here. I do. There we go. So here we are. And we are at, this is the 17 April expiration, 100 strike call for Akamai. Akamai is currently trading at 119. So we bought the option for 770. It's currently trading at $19.25. So this has now gone deeper in the money. Let's take a look at this one really quickly. Now, before we jump into the Greeks and the numbers here, let's go back over here. Let's put on the chart AKAM, Akamai. And woo, Akamai is kind of making that little bit of a blow off there, making that breakout of a resistance level above the 114 and 114, 115 range in today's trading. We're past the earnings announcement. Implied volatility starting to go up, which is working in our favor, right? We know that we've got another earnings announcement just over the horizon, peaking over the horizon there at 5.7. So implied volatility, if it goes to plan, what it has been doing previously, and it isn't a guarantee by any means, is that implied volatility is likely to continue to rise into that next earnings announcement, which is beneficial for this to us as the owner of that stock. But this is exactly, as a long option holder, this is exactly what you want to see, is that kind of big move to the upside. So let's go back to the trade. And we're long that Akamai call option with 23 days to go until expiration. So let's see what's going on with this trade, because the relevant forces are delta, and delta is probably becoming pretty significant here. The other relevant forces are implied volatility, and implied volatility going up works in our favor. But the primary relevant option Greek that we perhaps might neglect, but we want to pay attention to, is the inevitable, and that is the passage of time, because we're now perhaps at that point where the tug of war between delta and theta becomes perhaps a challenge in terms of holding on to this trade. So now the question is it better roll or close or leave it in place? So we're going to go to the trade tab here for Akamai, AKAM, Akamai. And we'll kind of pop this open here. Here we are. There's our long position, 17 April expiration. We're going to scroll. So notice something. Here's our 100 strike. And we are so deep in the money at this particular point, at that 100 strike, that it's essentially a one-to-one. This is a theoretical relationship, because it doesn't necessarily move one-to-one because you've got other factors at work. But because this has gone so deep in the money, because of this big blow-off, what's happened is that we've got an option that is essentially a cheaper, as far as leverage is concerned, as far as directional movement sensitivity is concerned, it's like owning shares of the stock. Now, the stock's trading at 119. The option's currently trading at $20. So it is, you think about that, that is a fifth of the value of the stock. But it's as if we're getting the movement of the stock. Now, it doesn't provide dividends. It doesn't provide voters, shareholder rights, those types of things, and it expires. This is kind of an interesting thing that happens. If I change this column from probability of touching, and I change that back to extrinsic value, look at what's going on here. So we're so far in the money with this option that we've lost nearly all of the extrinsic value in this particular position. So our sensitivities to implied volatility and our sensitivity to time decay really has gone to nothing. All right, so there's not a lot of sensitivity, just because simply there is just not a lot of extrinsic value for that to work on. And remember, at this point, the majority of the value of this option is what kind of value? intrinsic value, right? All but 16 cents or 15 cents of this option premium is intrinsic value. So here's the thing. Here's the problem. So options asks, how rare is it for the delta to go so high? Once you get deep in the money, once the price of the stock has made that big move, which is what you want to have happen, this is a position where an option trader may simply say, look, do I want to take the trade-off because it's made the move that it's made and I'm not going to get that much theoretically more, or do I increase my leverage by rolling this to a numerically higher strike, which has greater leverage, bigger percentage move, but it also has greater sensitivity to other things that are going on. Because look at what's going on here in this particular option. We have basically a delta of 1, which is a 1-to-1 relationship. So holding on to this 1 delta or 99-cent delta, roughly, option contract creates this following risk. You don't have a lot of time decay working against you. You don't have a lot of vega working for you if implied volatility is going up. So you're not getting a lot of work coming out of that extrinsic value. What you have at risk is intrinsic value, and you have dollar for dollar risk essentially at the moment. It's going to change because it's dynamic, but you essentially have dollar for dollar risk for the price of the stock. So if the price of the stock goes down, guess what? That's going to eat up pretty quickly your premium that you've kind of clawed your way to this premium because the price of the stock's gone up and now this option is deeper in the money. So what if the price of the stock, we go back to the chart here. What if the price of the stock were to take a dive back down to 114 or 115? It's currently sitting at 119. What if it were to take a $5 move to the downside? Well, if you're owning the stock, a $5 move is a significantly smaller percentage loss than a $5 move in a $20 premium in your option contract. So the leverage is kind of working backwards here, isn't it? So this might be a scenario to either close this trade down and simply take your profit in the trade, number one, or number two, roll this to a position that has greater leverage and ride the wave higher if that wave continues to move higher, because then you're going to get implied volatility sensitivity. If it's going up into that earnings announcement, you're going to get greater time decay, but you're going to get a bigger percentage move. Now you could lock in a little bit of premium in that gain. So let's think about doing that. Let's think about rolling this. So one objective result here could be simply taking this trade-off and booking some of that premium. Because if you don't do that, if a trader doesn't do that in this particular case, the potential risk is that dollar for dollar move, at least in the first couple of dollars, that dollar for dollar move, gain or loss in the option premium. So that leverage is cutting the opposite direction, but you're not getting a lot of time decay. You're not getting a lot of implied volatility change. So we could simply close this, or we could look at rolling. So let's think about if we were to roll this, and we'll kind of continue this discussion. If we were to roll this out for time and strike, we're at the 100 strike. So let's do this. We could sell that for about theoretically 19 or 20 bucks, somewhere in that range. If we were to roll this back out, say for instance, to the May 1 expiration, which is going to be out beyond this, or actually just before this earnings announcement, which might not be a bad place to be from that time frame, is where that earnings announcement is, because implied volatility is likely to rise to that point. We could look at rolling this out. Let's go to our trade tab, rolling this out to the 1 May expiration, and then rolling it to a strike that has some greater leverage, still in the money, has some intrinsic value, but also has some extrinsic value and doesn't have a lot of time decay. So maybe we roll this to also an in the money strike. Stock's currently trading at 119. Maybe we roll this to the 116 strike. We're going to be right about what we paid for it to begin with, and we've locked in some profit. So we're kind of coming back to the same place that we were. So let's think about rolling this to the 116 strike on the May 1 expiration. So we're going to go back to the monitor tab here and right click create a rolling order, buy this trade. So we're just going to kind of walk through the changes. By default, the platform rolls to the next available expiration at the same strike. We're not limited to that. So what we're going to do is we're going to go to the 1 May expiration, and we're going to roll that to the 116 strike. And we can do that for an $11.51 or 50-cent credit because we're locking in some of that profit on this trade. And now we're back to the same place that we were to begin with, and we can take advantage of that upward movement. Yeah, I'm not too terribly worried about the spread here. Volatility is pretty high today, and things are kind of banging around back and forth. I'm not too terribly worried with the width of that bid-ask spread in this case, Michael. But rolling depends on the liquidity of the target. So I know this is a relatively liquid stock. It's currently trading with about 2 million, almost 2.8 million shares today. If we weren't so volatile today, I would be maybe a little bit more concerned about the width of that bid-ask spread. So what I'm going to do is I'm going to look at rolling out time-wise and rolling up numerically to a strike that's higher, still in the money, still gives me some intrinsic value, but puts me back into the position that I was in to begin with on this trade when I had that bullish expectation. Now, you're right, CB. We could do that. We could roll it out another week for sure. Let's look at the number real quick. Let's go to the 15 May expiration. Oh, the 116 is not traded. So there's our answer. All right, we're going to go right here. We're going to click on confirm and send, and we're going to fire that order off. And we got it. Guys, I was so deep in talking about this that I ran out of time. So I'm just going to give you this really quickly. If you're going to want to learn a little bit more about this, dig into our Trader Talks webcast page here. Click on that subscribe button if you haven't done so already. My thanks to Mike Fairborn for helping out with this discussion. Thank you for getting me involved in this conversation. I was just right there in the middle of that, not even paying attention to calls from my producers on time. So my thanks to them as well. Guys, have a great day. I'll be back later this afternoon talking about index options as well. We'll see you then. Take care, everybody. Bye-bye.